Usually, when you pull up a company's financial report, you kind of expect immediate clarity.
Right. You want it to be black and white.
Exactly. It's like reading a thermometer. You look at a traditional retail company or like a software company, and you see revenue dip or margins compress, and you can just point right at the screen and go, there it is. The core business is struggling.
Right, because it's concrete. You're looking at a trailing indicator of past performance that just maps directly to current intrinsic value.
Right. You made money or you lost money. Simple. But when you step into the world of clinical stage biotech, that thermometer just shatters entirely.
Oh, completely. It's a totally different landscape.
We're looking at financial and diagnostic metrics that are fundamentally disconnected from traditional valuation. I mean, you might see this massive net loss on the balance sheet, but the equity is surging.
Yeah, all because of like a single efficacy signal in a phase 2 trial or something.
Exactly. The numbers on the page in a 10Q, they rarely tell the actual story of the company's enterprise value. And, that brings us to Compugen, ticker symbol CGEN.
CGEN, yep.
Welcome to a very special Talk Tickers deep dive today. We're putting on our Talk Tickers hats for this one, which means we are stripping away all the fluff.
Love it.
We are giving you a data-forward, plain language, opinionated, and highly actionable breakdown of their Q2 2026 earnings call.
And we really need to do this because biotech earnings calls are just notoriously hostile to the average retail investor.
I'll go the worst.
Right. They are so dense with medical jargon and, regulatory acronyms, complex accounting maneuvers. I mean, if you aren't fluent in both Wall Street financial engineering and cutting-edge cellular biology,
you're basically flying blind.
You're totally flying blind. So our mission today, for you listening, is to synthesize all that complexity. We're going to map the underlying science straight to the balance sheet.
And ultimately to the investment thesis.
Oh.
Okay, let's unpack this. Let's start with the hard data from Q2 2026.
The headline numbers.
Right, the headline numbers.
Yeah.
Chief Financial Officer David Silberman laid out a balance sheet that, it requires some immediate context.
It really does.
So revenue came in at $2.6 million.
Okay.
Which is actually a 100% year-over-year increase from $1.3 million in Q2 of 2025.
Still sounds small, though.
Right, exactly. Net loss was $7 million, which is a slight improvement from the $7.3 million the prior year. Earnings per share, or EPS, was a non-GAAP loss of 7 cents, which beat the 8-cent loss expectation. But, and this is the big but the most critical numbers here, the ones that dictate survival in this sector, are liquidity and burn rate.
Always.
They hold $125.3 million in cash and equivalents. Debt is absolute zero.
Zero debt. That's huge.
Massive. Operating cash burn was $21.9 million for the first half of 2026, and they're projecting a cash runway into 2029.
Okay, so when you look at that cluster of data, right?
Yeah.
That revenue line is a classic biotech red herring. I mean, to an investor who's used to, say, tech or consumer goods, $2.6 million in quarterly revenue for a publicly traded company sounds disastrous.
It's basically pocket change. It's like looking at a clinical stage biotech's revenue and judging a tech startup by how many t-shirts they sell, right?
Yeah, that's a great analogy. It misses the point entirely.
It just doesn't matter.
Because Compugen doesn't have a commercialized FDA-approved drug on the market yet. They aren't selling pills. That $2.6 million is entirely driven by milestone recognition from their partner, Gilead.
So it's accounting revenue, not fresh operating cash flow.
Exactly. The cash was already secured. Under revenue recognition standards, when a mega-cap pharma like Gilead pays a massive upfront sum to a smaller biotech for licensing rights, the biotech can't just slap that entire amount onto the income statement on day one.
Right. The SEC would not love that.
No, they would not. They have to amortize it. They recognize it as revenue over the life of the performance obligations. So that $2.6 million is just the accounting trail of a deal that's already done.
Specifically related to an upfront payment and an IND, an investigational new drug milestone.
Yep. It's just a trailing artifact of a really successful business development strategy. The true gravity of this earnings print is found in that liquidity profile.
The cash.
The $125.3 million in cash against zero debt. We really have to contextualize what that means in the macroeconomic environment of 2026.
Because the cost of capital is incredibly elevated right now.
It's brutal. The biotech sector has seen waves of mass extinction recently for small cap companies that just ran out of cash.
Yeah, and then they're forced to raise capital through those toxic, heavily dilutive secondary offerings, right? At totally depressed valuations.
Right, the dreaded dilution death spiral.
A company needs to run a phase 2 trial. They look up and realize they only have 8 months of cash left, so they panic. They issue millions of new shares at like a 40% discount, and it just destroys the equity of existing shareholders just to keep the lights on.
Precisely. And Compugen has completely insulated its cap table from that specific risk. By securing a cash runway into 2029, they bought the most precious commodity in drug development. Time. Clinical trials are inherently chaotic. Patient enrollment lags, the FDA suddenly requests supplementary data, manufacturing bottlenecks happen out of nowhere.
It's never a straight line.
Never. A 3-year runway allows management to navigate those inevitable delays without negotiating from a position of weakness. A zero debt balance sheet in a high-rate environment is a massive structural advantage.
Okay, so let's look at how they're actually deploying that capital. They burned $21.9 million in the first 6 months of the year.
Right.
You annualize that, and you're looking at roughly $44 million a year in operating cash burn. R&D research and development expenses ticked up to $6.3 million for the quarter, which is up from $5.6 million. And management was very explicit here. That increase is almost entirely allocated to their wholly owned MAIA clinical trial for their lead internal candidate, COM701, in ovarian cancer.
Right, their in-house baby.
But here's where it gets really interesting, and this is the dynamic we need to untangle today. They're spending $44 million a year internally, but the external partnerships are where the massive billion-dollar valuations are being tossed around.
Yeah, it's a dual-engine model. You've got the internal pipeline, which they fund themselves, and the partnered pipeline where the pharma giants step in and shoulder all the capital expenditure.
So let's break down that partnered pipeline. Let's start with Gilead. The asset is GS0321.
Right.
Now, prior to the licensing deal, Compugen called it COM503. The financials attached to this single molecule are just staggering. Compugen has already taken in $90 million in cash. Upfront. And they're eligible for up to $758 million in future development, regulatory, and commercial milestones. Plus tiered royalties ranging from the single digits to low double digits upon commercialization.
It's a monster deal, and we really need to understand the biology of what Gilead just paid nearly $1 billion in potential value to control.
Yeah, why is it worth that much?
So, GS0321 is an anti-IL-18 binding protein antibody.
Okay, that's a mouthful.
It is. To understand why Gilead wants this, you have to understand the tumor microenvironment and the role of cytokines.
Cytokines. Okay, so cytokines are essentially the chemical messenger system of the immune response, right? They're kind of like the flare guns. They tell the body's T cells and natural killer cells where the infection or the cancer actually is and how aggressively to attack it.
That's a perfect analogy, the flare guns. And IL-18, interleukin-18, is an incredibly potent cytokine. It's highly inflammatory.
So there's a big flare.
A huge flare. In theory, having a lot of IL-18 around a tumor should trigger a massive immune response to just destroy the cancer. And for years, the oncology field knew this. They actually tried injecting patients with synthetic IL-18 to supercharge the immune system.
But it failed, right.
Consistently failed in clinical trials.
Mate, why did it fail? I mean, if it's a flare gun for the immune system, shouldn't more flares automatically equal a better response?
You would think so. But cancer cells are evolutionary survival machines. They adapt.
Shaky.
Very. When tumors sense the presence of high levels of IL-18, they actually produce a decoy receptor called IL-18 binding protein, or IL-18BP.
Yep.
This binding protein acts like a sponge. It physically attaches to the IL-18 and neutralizes it before it can activate the immune cells. So going back to your analogy, the body is firing off the flare guns, but the tumor has deployed a chemical blanket that snuffs out the flares instantly.
Oh, wow. So the signal never reaches the immune system.
Exactly.
And that is where Compugen's computational biology comes in, doesn't it?
Yeah.
They recognize this mechanism of resistance. If the tumor is using IL-18BP as a shield, the selection isn't to just keep pumping more IL-18 flares into the body.
Yeah, that won't work.
The solution is to destroy the shield.
Bingo. GS0321 is an antibody specifically designed to bind to that IL-18 binding protein and block it. By neutralizing the tumor shield, the naturally occurring IL-18 in the patient's body is suddenly free to do its job.
The flares finally go up.
The flares go up, The immune cells activate, they swarm the tumor microenvironment, and they attack the cancer. It is a highly elegant, targeted approach to immunotherapy.
Because it's local.
Right. It doesn't overstimulate the entire immune system, which causes severe, sometimes fatal toxicity. It just removes the localized suppression right around the tumor.
That is fascinating. So this drug is currently in a phase I dose escalation trial.
Yes.
But for retail investors looking for immediate gratification, this is where your patience gets tested. CEO Eran Ophir noted that the trial is progressing as planned, testing both monotherapy and a combination with a PD-1 inhibitor. But when he got pressed by Stephen Willey from Stifel during the Q&A about actual data readouts, Ophir essentially shut it down.
He had to.
Yeah. 18 months into a phase I study, they're doing what they call backfill cohorts, testing more patients at optimal dose levels to ensure safety before they expand. With a partner like Gilead, the information flow is tightly controlled.
Oh yeah, an iron grip.
We aren't going to see material data until Gilead is good and ready to showcase it at some major medical conference.
Which, that is just standard operating procedure for big pharma partnerships. You trade transparency and control for non-dilutive capital and massive commercial infrastructure.
It's the deal you make.
Right. Gilead is running the trial, Gilead is paying for the trial, and Gilead will decide when the data sees the light of day. So for a Compugen shareholder, this asset is really a background generator of long-term value.
And this is a big but the second partnership is not operating in the background at all.
No, it's front and center.
It is moving at an aggressive, almost unprecedented pace. I'm talking about AstraZeneca and their drug, rilvegostomig.
Yeah, try saying that 3 times fast.
I know, right? Rilvegostomig. This is a bispecific antibody targeting both PD-1 and TIGIT. And AstraZeneca took the TIGIT component entirely from Compugen's wholly owned COM701 program.
That's right.
On the earnings call, management highlighted that AstraZeneca has initiated a 12th phase 3 trial for this drug. We really need to pause and reflect on the magnitude of that number, 12 phase 3 trials.
It's wild. The capital expenditure required to run 12 global multi-center phase 3 oncology trials is astronomical. We are talking hundreds of millions, potentially billions of dollars in clinical operating costs.
And AstraZeneca is not doing this on a whim.
Absolutely not. They have seen the internal phase 1 and phase 2 data, and they are pushing all their chips to the center of the table.
Okay, so let's break down the mechanics of the drug itself. Rilvegostomig is a bispecific antibody, meaning instead of giving a patient 2 separate intravenous drugs like one to target PD-1 and one to target TIGIT AstraZeneca, it engineered a single molecule that binds to both targets simultaneously.
Right, and the biological synergy here is critical to understand. Both PD-1 and TIGIT are what we call immune checkpoints.
Checkpoints.
Yeah. Let's go back to the idea of the immune system acting as the body's defense force. You want your T cells to aggressively attack foreign pathogens and mutated cancer cells, right?
Right.
But you don't want them to attack healthy tissue. So the immune system has these built-in braking mechanisms, checkpoints, to prevent autoimmune disease.
And PD-1 is the most famous of these breaks, isn't it?
Oh, by far.
When a T cell's PD-1 receptor links up with a PD-L1 protein on a normal cell, it basically tells the T cell, stand down, I belong here.
Yep, it's an ID check.
But cancer cells hijack this. They coat themselves in PD-L1 proteins, essentially putting on a fake ID. The T cell comes up, checks the ID, hits the PD-1 brake, and leaves the cancer cell alone to keep growing.
Exactly.
And drugs like Keytruda or Opdivo are PD-1 inhibitors, right? They block that interaction, cutting the brakes and allowing the T cell to actually attack.
Exactly. And that mechanism revolutionized oncology over the last decade. But, we found that blocking PD-1 alone just isn't enough for many solid tumors. The immune system is highly redundant.
So what happens?
If you cut the PD-1 brake, the T cell eventually gets exhausted from the sustained attack. The tumor adapts again and engages a secondary brake system, and that secondary brake is TIGIT.
Oh, wow. So if you block PD-1, the tumor just upregulates TIGIT to shut the immune response down all over again.
Right. It's playing whack-a-mole.
Right.
So the logical next step in immuno-oncology is a dual blockade. You cut the primary brake, PD-1, and you simultaneously cut the emergency brake, TGIG5.
And rilvegostomig does both in a single molecule.
Exactly. It forces a localized, highly concentrated immune activation right at the site of the tumor.
And AstraZeneca is testing this dual blockade strategy in a newly announced phase 3 trial called Tropion Urothelial 04.
Right.
They're targeting high-risk muscle-invasive urothelial carcinoma. So bladder cancer that has actually grown into the muscle wall. But they aren't using rilvegostomig alone here. They are combining it with another drug from their pipeline, Datroway, which is a TOP2 ADC.
And this combination therapy is literally the cutting edge of modern oncology.
So let's deconstruct the ADC, the antibody drug conjugate.
Yes. An ADC is essentially a guided missile for chemotherapy. Think about traditional chemotherapy. It's systemic, right? You just flood the entire bloodstream with toxins, hoping to kill the fast-dividing cancer cells slightly faster than you kill the patient's healthy cells.
It's a brute force approach.
Total brute force. And it comes with severe collateral damage. Hair loss, nausea, immune suppression.
But an ADC changes the delivery mechanism entirely.
It does.
It has three parts. You have the antibody, the payload, and the linker. The antibody is designed to seek out a highly specific protein expressed on the surface of the cancer cell. In the case of Datroway, that target protein is TOP2.
Right. TOP2 is a transmembrane glycoprotein that is overexpressed in many solid tumors, including urothelial carcinoma. So the antibody acts as the homing device. It circulates in the blood, completely ignores the healthy cells, and latches right onto the TOP2 protein on the tumor.
And once it binds, the cancer cell actually swallows the antibody, drawing it inside.
Yes.
That's when the second component, the linker, comes into play. The linker is this chemical bond designed to remain totally stable in the bloodstream, but it dissolves once it is inside the highly acidic environment of the cancer cell.
And when that linker breaks, it releases the third component, the payload.
The payload.
And the payload is a highly potent cytotoxic chemotherapy. But because it's delivered directly inside the cell, it is vastly more toxic to the cancer than traditional chemo, while minimizing those awful systemic side effects. It essentially destroys the cell from the inside out.
And here is where the synergy with Compugen's drug comes into focus. Datroway, the ADC, blows up the cancer cells. This localized destruction causes tumor antigens to spill into the surrounding environment, acting like blood in the water.
Good analogy.
The immune system senses the debris and sends T cells to investigate. But those T cells would normally be suppressed by the tumor's defensive checkpoints.
And that is exactly when rilvegostomig steps in. It blocks the PD-1 and TIGIT breaks on those arriving T cells. So you have this incredible 1-2 punch. The ADC acts as the immediate targeted demolition crew, and rilvegostomig empowers the patient's own immune system to act as the cleanup crew, hunting down any microscopic disease that got left behind.
It's a profoundly rational combination.
Very rational.
It's theoretically brilliant, but the market demands clinical proof.
Show me the data.
Right. And we got a glimpse of that proof on the earnings call. Eran Ophir highlighted data presented at ASCO, the American Society of Clinical Oncology, from a study called Gemini.
Ah, yes. Gemini.
This trial evaluated rilvegostomig combined with standard chemotherapy in first-line biliary tract cancer. Biliary tract cancer is an incredibly aggressive, difficult-to-treat malignancy of the bile ducts and gallbladder.
It's awful. The historical benchmarks for this disease are really grim. Standard of care, which involves intense chemotherapy regimens, typically yields an overall survival of less than 13 months.
Less than 13 months. But the Gemini data showed that adding rilvegostomig to chemotherapy pushed median overall survival to 16.8 months.
A nearly 4-month extension of overall survival in a first-line metastatic setting is a highly meaningful clinical benefit. I mean, it validates the biological hypothesis that dual PD-1 and TIGIT blockade can deepen and prolong the response to cytotoxic therapies. As management noted, this prolonged stabilization supports the thesis that rilvegostomig could become an immuno-oncology backbone therapy.
A backbone therapy. That is the holy grail for big pharma.
Oh,
It means the drug isn't just some niche treatment for one specific cancer. It becomes the foundational layer that you prescribe across multiple different cancer types, combining it with various ADCs or targeted therapies.
Right, everyone gets the backbone.
And if rilvegostomig becomes a backbone, the addressable market is astronomical. AstraZeneca has publicly guided that rilvegostomig has a non-risk adjusted peak year revenue potential of over $5 billion. $5 billion annually. And Compugen is sitting on $195 million in remaining milestones, plus mid-single-digit tiered royalties if it crosses the finish line.
If you model out a mid-single-digit royalty on $5 billion in peak sales, you are looking at hundreds of millions of dollars in pure margin cash flow, dropping straight to Compugen's bottom line annually.
Without them spending a dime on commercialization or marketing.
Nothing. It's pure profit.
Which begs the fundamental question, right? Compugen is a relatively small biotech operating out of Israel. How did they manage to map the biology that led to the TIGIT target utilized in a potential $5 billion drug, and the IL-18 target that Gilead bought for nearly $1 billion?
That's a great question.
They don't have the massive high-throughput physical screening labs of a Pfizer or a Merck.
No, they don't have the physical labs, but they have a distinct computational advantage. The answer lies in their proprietary AI and machine learning discovery platform, which they call Unigen.
Right. And this is a major focal point of Eran Ophir's commentary. We hear AI constantly in the biotech space right now.
It's the ultimate buzzword.
Every startup claims to be an AI-driven drug discovery company. But Ophir made a really crucial distinction about what Unigen actually does. He said, and I quote, "Our focus is not on using AI to optimize non-biology, but on uncovering innovative opportunities to activate the immune system against cancer."
Right.
Let's translate that. What does he actually mean by optimizing non-biology?
Okay, so many companies use AI for structural drug design. They have a known biological target, say a specific protein receptor, and they use AI to virtually test millions of chemical compounds to see which one fits into that receptor the best.
Okay, that makes sense.
They're optimizing the chemistry, the physical shape of the drug. That is valuable, obviously, but it is fundamentally a chemistry problem. Compugen's approach is entirely different. They aren't using AI to build a better key for a known lock. They're using AI to discover locks that no one else even knows exist.
That's a huge distinction. So they're using computational biology to map the human immune system at a transcriptomic and proteomic level. They're sifting through massive data sets of human tissue samples, comparing healthy tissue to tumor microenvironments, and looking for statistical anomalies in protein expression.
Yeah, because the human genome produces tens of thousands of proteins, interacting in networks of unimaginable complexity. Traditional target discovery involves scientists basically making educated guesses based on decades of literature and then testing those hypotheses in a lab over years.
Trial and error.
Lots of error. But Unigen ingests the raw data of human disease and uses machine learning algorithms to identify predictive patterns. The AI asks, what proteins are consistently overexpressed in the presence of this specific cancer, and how do they interact with the immune cells trying to fight it?
It's the difference between exploring a dark room with a tiny flashlight versus just turning on the overhead lights.
Exactly.
Unigen identifies COM701, COM902, and GS0321 computationally before a single physical experiment was even run. They drew the blueprints digitally, validated them in vitro, and then licensed the most expensive late-stage development work to mega-cap pharmas.
It is a masterclass in de-risking a pipeline. Phase 3 clinical trials are where biotech companies go to die.
It's so true.
The failure rate is brutal, and the capital expenditure is devastating. By offloading the TIGIT and IL-18 programs to AstraZeneca and Gilead, Compugen retains this massive financial upside, the royalties and milestones, while completely shifting the execution risk and capital burden off their own balance sheet.
Which brings us back to that $44 million annual cash burn we talked about earlier. Because they outsource the heavy lifting on those partnered assets, they can afford to channel their own internal capital directly into their most promising proprietary asset.
The MAIA trial.
Yes, the MAIA-ovarian clinical trial evaluating COM701. They retain 100% of the rights to this program. If the partnerships are the financial safety net, the MAIA trial is the primary engine for near-term value creation.
If you hold CGN equity, MAIA is the absolute focal point of your investment thesis right now.
So let's transition into the forward-looking guidance for MAIA, because the Q2 earnings call fundamentally shifted the narrative around this trial. Management confirmed that the interim analysis for the MAIA trial is locked in for the first quarter of 2027.
Q1 2027.
That's the critical catalyst date. But the most intensely scrutinized segment of the call, the issue that totally dominated the Q&A with analysts, was a strategic adjustment to the trial's benchmarks.
Oh, yeah. This is where we really have to dive deep into the mechanics of clinical trial design, biostatistics, and regulatory strategy.
It got in the weeds.
It did. Because a slight shift in a benchmark can change the entire Wall Street perception of a drug's viability.
So management announced that they are lowering their expectation for the placebo control arm's progression-free survival, or PFS.
Right.
Previously, their internal modeling assumed the placebo patients would go roughly 5.5 months without their cancer progressing, On this call, they adjusted that expectation down to approximately 4 months.
From 5.5 to 4.
Yeah. And I mean, if I am a retail investor listening to that update, my immediate reaction is highly skeptical. It sounds like they're moving the goalposts, right?
It does.
It sounds like they realize their drug isn't performing as well as they hope, so they're just artificially lowering the baseline to ensure COM701 looks like a success when the data unblinds.
It is the most natural, cynical assumption an investor can make. And it's exactly why Stephen Willey from Stifel pressed Chief Medical Officer Michelle Mahler on the underlying rationale. But when you look at the mechanics of how the MAIA trial is structured, you realize it's not about manipulating the benchmark. It is about anchoring the statistical model to shifting real-world data.
Okay, so we need to explain the blinding mechanism here. MAIA is a blinded, randomized, placebo-controlled trial. There are 60 patients enrolled. They're using a 2-to-1 randomization ratio. Roughly 40 patients receive the actual drug, COM701, and 20 patients received placebo. Both groups received the standard of care chemotherapy alongside it. But crucial to this entire discussion, Compugen does not know which patient is in which group.
Exactly.
The trial is blinded to both the investigators and the patients to prevent bias.
Because they're blinded, management is just watching the aggregate data roll in. They can see how long the pool of 60 patients as a whole is surviving without progression, but they can't separate the COM701 patients from the placebo patients. To model the statistical powering of the trial, they have to rely on historical assumptions about how those 20 placebo patients should be performing.
And their original anchor for that assumption was 5.5 months. Why 5.5?
That 5.5-month benchmark was derived from historical data, specifically the original registration trials for a class of drugs known as PRP inhibitors, which were the last major breakthrough in this specific setting.
Okay.
They looked at the placebo arms of those old trials and said, okay, our placebo patients should perform similarly. But the landscape of oncology is constantly evolving. The standard of care shifts. The type of patient entering a clinical trial today is fundamentally different from a patient entering a trial 5 years ago.
And that shift was brought into sharp focus by 2 recent European trials, right? TADOVA and ORIO.
Yes.
These trials evaluated a similar patient population relapsed platinum-sensitive ovarian cancer. And the data from those trials was shocking. The placebo arms didn't hit 5.5 months. They achieved a median progression-free survival of just 2.8 months.
2.8. It was a massive downward revision in real-world outcomes. When that external data published, Compugen's medical team had to reevaluate their internal models.
Of course.
Why did the patients in those European trials progress so much faster than the historical baseline? Michelle Mahler explained that the patient populations, while nominally similar, had completely divergent clinical histories.
The patients in TADOVA and ORIO were more heavily pretreated, right?
Exactly.
They had endured more lines of prior therapy, meaning their cancers had survived multiple rounds of biological warfare and were highly mutated and aggressive. They also allowed patients who had previously failed treatment with bevacizumab, an anti-angiogenic drug, and crucially, they included patients with liver metastases.
And liver metastases are a hallmark of widespread, highly aggressive disease with a very, very poor prognosis. Compugen's MAIA trial specifically excludes patients with liver metastases.
Okay, so Compugen is looking at the landscape. They have the old historical data saying 5.5 months. They have the brand new European data on highly pretreated patients saying 2.8 months. They know their own patient population sits somewhere in the middle.
Right.
They're more pretreated than the historical trials, but healthier than the European trials because they excluded the liver mets. So they mathematically triangulated a new expectation for their control arm, approximately 4 months.
Which is the mathematically responsible thing to do in a Bayesian trial design. You must update your prior probabilities based on new evidence. I mean, if you refuse to update your model when the external landscape changes, your statistical powering will be entirely disjointed from reality.
And Eran Ophir jumped in to emphasize the most important aspect of this entire debate. The adjustment of the benchmark only affects their internal modeling right now. When Q1 2027 arrives and they finally unblind the data, the external benchmarks basically cease to matter. They aren't going to compare the COM701 patients to the TADOVA trial or the ORIO trial. They are going to compare the 40 patients who received COM701 directly against the 20 patients in their own trial who received the placebo.
The trial generates its own internal truth. The placebo arm is the ultimate arbiter. If the internal placebo patients progress at 4 months and the COM701 patients progress at 7 months, that delta, that 3-month gap, is the pure, statistically measurable treatment effect of the drug.
So the controversy over the shifting benchmark is really just noise surrounding the statistical modeling.
Total noise.
The final data will speak for itself. Okay, so that establishes the baseline. But we need to know the goal. What does clinically meaningful success actually look like for COM701 in this setting? Management was very specific. They are targeting a progression-free survival of at least 6 months.
6 months. Now, to an observer outside of the medical field, a 6-month delay in cancer progression might sound kind of insignificant in the grand scheme of a human lifespan. But in the specific pathology of ovarian cancer, 6 months is the absolute critical threshold.
It's the dividing line between two entirely different disease states, isn't it?
It really is.
We have to translate the oncology jargon here to understand the gravity of that number. In ovarian cancer, the primary weapon is platinum-based chemotherapy. It's highly toxic, but it is highly effective at shrinking tumors. The entire classification of an ovarian cancer patient's disease is based on a ticking clock that starts the exact moment they finish their last round of platinum chemo.
If a patient finishes chemo, the cancer recedes but then begins to grow again in less than 6 months, they're clinically classified as platinum resistant.
And that transition to platinum resistant is catastrophic.
Yeah.
It means the cancer cells have genetically mutated, they have developed cellular pumps to flush out the platinum toxins, or they've upregulated DNA repair mechanisms to fix the damage the chemo causes. Platinum chemotherapy will generally no longer work on these patients.
Right.
They have to transition to non-platinum options, which historically have much lower response rates, shorter duration of benefit, and incredibly harsh side effects. It represents a steep drop in overall prognosis.
However, if a patient can go beyond that 6-month mark without the cancer progressing, they remain classified as platinum sensitive. This means that when the cancer inevitably returns, the oncologist can hit it with platinum chemotherapy again, and it is highly likely to respond.
So COM701 is being tested as a maintenance therapy. The patient finishes their chemo, they're in a fragile state of remission, and they start taking COM701. If the drug works, it keeps the immune system actively suppressing the microscopic disease for over 6 months. It prevents the cancer from rebounding.
And in doing so, it preserves the patient's platinum sensitivity. It keeps their best clinical weapon viable for the next round of the fight. It is not just about giving the patient a 6-month reprieve from the toxic side effects of chemotherapy, though obviously the quality of life improvement there is massive. It is about fundamentally altering the trajectory of the disease. It keeps them in a treatable category.
That context transforms the numbers on the earnings call into profound human stakes.
It really does.
But how does this data translate into a regulatory strategy? If COM701 hits that 6-month mark in Q1 2027, what is the pathway to actually getting the drug approved by the FDA? Analyst RK from H.C. Wainwright probed this exact point, asking if the MAIA trial data could support an accelerated approval pathway on its own.
And Michelle Mahler's response was very disciplined. She explicitly stated that MAIA is an exploratory signal-seeking trial. With only 60 patients, it is not a registrational phase 3 trial powered for definitive statistical superiority. A regulatory agency is rarely going to grant full approval based on an N of 60 in a randomized setting. However, the trial is meticulously designed to serve as the foundation for a pivotal registration trial, specifically aligning with the FDA's Project Frontrunner initiative.
Project Frontrunner.
Yeah.
This represents a massive paradigm shift in how the FDA views oncology drug development. Historically, the regulatory pathway for a new cancer drug required it to be tested in the most advanced, heavily pretreated patients, people who had failed 3rd, 4th, or 5th-line therapies.
The sickest of the sick.
Exactly. If the drug showed a benefit in that salvage setting, the FDA would approve it. Then, the company would spend the next decade running new trials to move the drug into earlier lines of treatment.
But the FDA recognized that this archaic system was structurally denying earlier stage patients access to life-saving innovation. Furthermore, testing immunotherapies on patients whose immune systems have been completely decimated by 5 rounds of toxic chemotherapy often masks the true efficacy of the drug.
Makes sense.
Project Frontrunner is a direct mandate from the FDA. They want companies testing novel therapies in earlier clinical settings, like first-line or early maintenance, right from the beginning.
And by testing COM701 as an early maintenance therapy in patients who have just responded to platinum chemotherapy, Compugen is perfectly aligned with the FDA's current regulatory philosophy. They are, skating to where the puck is going.
And they are utilizing a Bayesian trial design to maximize the efficiency of the data collection.
We briefly touched on Bayesian statistics earlier in regards to updating the control arm expectations, but let's compare it directly to traditional trial design to really understand the advantage here. Traditional clinical trials use frequentist statistics.
Right. In a frequentist trial, you establish a rigid protocol. You say, we need exactly 500 patients. You enroll all 500, you run the trial for 3 years, and you do not look at the data until the very end. You unblind the results, run the p-value, and it is a binary pass or fail.
Right.
It is rigid, slow, and incredibly expensive.
But a Bayesian trial design is completely dynamic. It applies Bayesian probability, which allows the statistical model to update continuously as new data arrives. It starts with a prior probability, an initial assumption based on historical data. As the first 10 patients generate data, that information is fed into the model to create a posterior probability. The model constantly learns.
This allows for adaptive trial execution. If the drug is failing miserably early on, the Bayesian model will flag it, and the trial can be halted early for futility, saving millions of dollars and preventing patients from receiving ineffective treatment.
That's a big deal.
Conversely, if the drug is overwhelmingly effective, the model can establish statistical significance with a much smaller sample size than a frequentist design would require. The FDA heavily favors Bayesian designs in early-stage oncology because they are ethically sound and highly efficient.
So even though the Q1 2027 MAIA readout won't likely trigger immediate commercial approval, it provides the precise FDA-aligned Bayesian-validated data set required to launch a definitive, pivotal Phase 3 trial. It builds the impenetrable scientific case for the molecule.
Exactly. It de-risks the final leap toward commercialization.
Wow. We have dissected an immense amount of complex data today. We've mapped the zero-debt balance sheet, explored the multi-billion-dollar economics of the AstraZeneca and Gilead partnerships, unpacked the Unigen AI discovery engine, and analyzed the shifting statistical benchmarks and deep biology of the MAIA-ovarian cancer trial.
It's a lot.
It is, but it is time to execute the final mandate of the Talk Chickers format. We need to move to the bottom line. What is the synthesis? What does this mean for you, the retail investor who holds CG in equity today, or the investor analyzing the Q2 print, trying to decide if the current valuation presents a buying opportunity?
To formulate an actionable thesis, we really have to synthesize the 3 core pillars of value presented on this call. Pillar 1, the balance sheet. They possess $125 million in cash, generating zero debt service, effectively funding operations into 2029. Pillar 2, the partnered pipeline. AstraZeneca is executing 12 Phase 3 trials for an ADC combination therapy with a $5 billion peak revenue projection, while Gilead is advancing a novel IL-18 targeted therapy with nearly $1 billion in total deal value on the table.
Staggering.
And Pillar 3, the wholly owned internal catalyst. A Bayesian-designed, FDA-aligned ovarian cancer trial reading out in Q1 2027.
So when you aggregate those 3 pillars, what is the ultimate verdict? Is the Q2 earnings print a bullish or bearish signal for the underlying equity?
From a fundamental intrinsic value perspective, the signal is unequivocally bullish. The structural foundation of the company is incredibly robust. However, it requires a massive asterisk regarding time horizons. It is a highly bullish setup specifically for the patient, structurally minded investor.
The asterisk is all about the catalyst calendar.
Exactly. The modern retail market is dominated by short-term trading, option speculation, and the constant pursuit of near-term binary events. If you are a trader looking for a volatile stock that is going to gap up 40% next week on a surprise data drop, Compugen is the wrong vehicle for your capital.
It's just not going to happen.
No. The nearest major internal binary event that has the power to fundamentally re-rate the valuation of the company, the MAIA trial unblinding, is firmly scheduled for Q1 2027. We are currently in the middle of 2026.
That means we are staring down the barrel of 6 to 9 months of relative quiet on the proprietary pipeline front. Furthermore, AstraZeneca's massive Phase 3 readouts are generally guided for post-2027, and the Gilead IL-18 asset is still churning through the meticulous, slow process of Phase I dose escalation. There is no immediate dopamine hit on the horizon.
And without a near-term catalyst, clinical stage biotech stocks tend to drift. They become highly susceptible to broader macroeconomic currents, interest rate fluctuations, sector ETFs rebalancing, or general market sentiment. The stock may trade sideways or experience low volume volatility for the next half year.
But if an investor can look past the next 6 months and view this through the lens of structural options pricing, the setup is incredibly asymmetrical.
Yeah.
Let's talk about the concept of the free call option.
Right. So in financial theory, a call option gives you the right to participate in the upside of an asset without committing the full capital required to own it outright. When you buy a share of Compugen at its current valuation, the market is almost entirely pricing in the risk and uncertainty of the internal MAI trial.
Right.
The market is looking at a small cap Israeli biotech burning $44 million a year and valuing the equity based on whether COM701 will succeed or fail.
But bundled inside that equity structure is a massive external lottery ticket.
Right. You are inherently acquiring a call option on AstraZeneca's 12 phase 3 trials and Gilead's phase I program. The capital expenditure required to run those trials is staggering, but Compugen isn't paying a dime of it. AstraZeneca and Gilead are shouldering 100% of the execution risk and the financial burden. Yet, if those trials succeed, Compugen is legally entitled to hundreds of millions in milestones and highly lucrative royalty streams.
You get the upside exposure of a mega-cap pharma's R&D budget without the dilution risk that normally accompanies it. And that lack of dilution risk is the ultimate safety net. Because they are funded into 2029, the greatest existential threat to a small-cap biotech investor, a sudden, desperate equity raise that slashes the value of your shares in half, is functionally removed from the near-term equation.
That is the core takeaway here. It is exceptionally rare to find a clinical stage biotech with zero debt, 3 years of runway, a wholly owned advanced clinical asset, and multiple partnered shots on goal being funded by the largest pharmaceutical companies on the planet. The fundamentals presented in this Q2 print are structurally rock solid. The execution is methodical. The risk profile is aggressively managed. You simply have to possess the discipline to let the calendar turn to 2027.
You're buying the blueprints, you're watching the big pharmas fund the construction, and now you just have to wait for the building to open. I want to thank you for bringing such intense clarity to this deep dive. Navigating the intersection of Bayesian trial design, TROP2 ADCs, and milestone accounting is an incredibly dense intellectual exercise.
Yeah.
You really made the complex accessible.
It's a fascinating ecosystem to deconstruct. The science and the finance are just inextricably linked here.
Before we sign off, I want to leave you, the listener, with a final provocative framework for evaluating this company. We started this deep dive by noting how Wall Street demands neat categorization. If you pull up Compugen on a Bloomberg terminal, they're classified as a clinical stage immuno-oncology company. They are grouped with hundreds of other small biotechs running cancer trials. That is the box the market forces them into.
Right. It's the standard industry taxonomy, based entirely on their current clinical output.
But I want you to step back and look at the origin story of that clinical output. Every single major asset we discussed today, COM701 in ovarian cancer, the TIGIT component fueling AstraZeneca's $5 billion ADC combination, and the IL-18 binding protein antibody that Gilead paid nearly $1 billion to acquire, was not discovered through traditional lab screening.
No, they were all computationally identified by Unigen, Compugen's proprietary AI and machine learning platform.
The platform successfully mapped the complex hidden biology of the human immune response and generated targets that the most sophisticated pharmaceutical companies in the world recognized as highly, highly valuable.
Yep.
So as you look at your portfolio, I want you to consider a fundamental question of identity. If a single computational model can consistently predict human disease biology with such precision that it commands billions of dollars in external pharma validation, are you actually investing in a traditional biotech company? Or, when you buy equity in CGEN, are you essentially buying an advanced, highly specialized AI data company that has simply chosen the oncology market as its first proving ground?
If the market ever begins to view them through the lens of an AI data engine rather than a single asset biotech, the valuation multiples shift dramatically. It completely rewrites the paradigm.
It changes everything. Thank you for joining us on this expanded, comprehensive Talk Tickers deep dive. We hope we proved today that understanding the true value of your investments requires moving past the headline numbers and understanding the fundamental science driving them. Stay disciplined, stay informed, and we will see you next time.